Hello, this is a video synopsis of the chapter 12, of chapter 12. Let me go back to the beginning here. I didn't realize I was at the end of this. Hang on a second. So this chapter is about behavioral finance and technical analysis. So this behavioral finance is a really interesting field, and I hope you'll find this chapter interesting. I think this chapter is very helpful for you as you, if for the future, as you begin investing and as you invest throughout your life, because we can all succumb to these behavioral issues where we're not acting logical with our money or by investing. And even though I teach this stuff and I live and breathe this stuff, I still catch myself falling into these behavioral finance traps. So we're going to talk about a few of them. And then at the end of the chapter, we're going to talk about the technical analysis. And if you go, make sure that you, excuse me, make sure that you also go to the video where I have additional instructions for the portfolio reports, because I talk about technical analysis there specifically. The ones that I wanted you to use for the report, and that was the moving averages, the Bollinger Bands, and the RSI, the relative strength indicator. So make sure that that gives a more specific explanation of the technical analysis. So make sure you look at that also before you take the final exam. Okay, so anyway, getting back to behavioral finance. So this is a fairly, behavioral finance theory is a fairly recent, within the last 25 years or so, fairly recent area of finance, because people realize that the underlying assumptions in finance are that people are risk averse, which we know to be true, but also another underlying assumption was that people are logical with their money. And we have found that people are not logical with their money. Let me give you an example. Let's say that you went to the store. Let's say you went to a clothing store, let's say Johnny's clothing store in Thibodaux, Louisiana, downtown Thibodaux, a great store for clothes. And Johnny says, I have this suit that's $295, but I'm going to sell it to you today for $350. Well, you would look at Johnny like he was crazy, and you'd walk out of the store, right? Because why would you buy something that's more expensive than the retail price? But think about investments. What are people doing when stocks are going up? People are all excited, and the market is really all about greed and fear, and it's dictated. People's emotions or behaviors are dictated by greed and fear. So why do people tend to buy when the market's going up? Well, because it's the greed factor. They don't want to miss out on making money in the stock. So when stocks are going up above above the price they should be, just like my example with clothing, that's when you should not be buying, but that's when people are buying. If you went to Johnny's shop and he said, oh, this suit is $295, but I'm going to sell it to you today for $250, it's on sale, you would buy it, of course. But when stocks are going down, people are not buying because the fear takes over the greed. But when stocks are going down, that's precisely when you should be buying. So anyway, so the whole premise is we should be buying low and selling high. But if we let emotion get into the picture, people tend to buy high and sell low because a lot of people buy when things are on an uptrend, and then they're afraid to buy when things are on a downtrend because they're afraid things will go lower. And then so the result is they don't buy when they should be. They buy high and they sell low, which you should be doing just the opposite. Okay, so anyway, hopefully you get the gist of what I'm saying there. So let's talk about some specific behavioral finance issues, some traps that people fall into, besides the herd mentality of wanting to buy when the things are going up and wanting to get out when things look bad and are going down, which you should be doing just the opposite. That's where dollar cost averaging comes into play. That was in a that was a couple chapters ago when there was a question on the quiz and on the last exam. So if you dollar cost average, that takes the emotion out of investing. I'm just gonna decide I'm gonna invest $100 in a mutual fund or an ETF on the 5th of the month. Let's say it's going to come out of my checking account, go into my Robinhood, Schwab, or Fidelity account, and I'm not even going to worry about it. So when the stocks are down, I'm getting a good price. When stocks are up, not so good of a price, but it takes the emotion out of it, and that's one of the theories behind dollar cost averaging. Okay, so let's move forward and take a look at behavioral finance. So it's just behavioral finance is trying to merge finance with psychology, and trying um, to look at these human behavior at how human behavior affects decisions, and try to look at some of these biases that we have. And if you understand what these biases are, then you can not um, not be a victim of those in your own investment account. Okay, so let's look at a few of these. Overconfidence, that's where if you've made money in the market recently, or if you've made some good trades or some good investment decisions, it gives you overconfidence. So if you've been successful in the market, you have confidence. You have too much confidence. When some people, as I've told you earlier this summer, most professional managers don't beat the market consistently, and most people don't beat the market consistently. So if you've beaten the market, are you smarter than everybody else, or is it just luck? And a lot of these professional managers, they they get one thing right, they make one good call or one good investment, and then they try to ride on the coattails of that. So it gives people overconfidence when they've made some good decisions. Conversely, if you've made some bad decisions, let me back up for a second. What does overconfidence translate to? It means you're going to take more risks. Also, if you're playing with house money, you're going to take more risks. In other words, if you've made enough money to where you're just playing with profits, you're going to take more risks. Conversely, let me get back to the overconfidence thing. If you've made some bad decisions, which is really just probably bad luck, not anything that you did wrong, and you lost some money, then you tend to have underconfidence, and you're not taking enough risk. You're too conservative. So you've got to really try to concentrate on taking the emotion out of your investing. Um, so that's overconfidence. The illusion of knowledge, that's where people spend hours and hours and hours and hours studying the fundamentals, studying the technicals, just reading everything they can about individual stocks in the market, and they think because they have all this knowledge that they're going to be able to make money in the market or beat the market. Not the case. There is not a significantly positive correlation between the amount of research that you do and how much knowledge you have, or how good you are at the market. So now I'm not saying you shouldn't do anything, but you know, there's just because you've done all this research, we can't predict the future. Anything can happen. So the illusion of knowledge is a problem where people basically have overconfidence because um, they have read up a lot about a particular stock or about the market in general. Okay, the disposition not effect. Okay, that is basically the pain of losing. Studies have shown that the pain of losing is much more painful than the elation of winning. In other words, the pain of losing money is much worse than the elation of making money. And so that can cause people to be too conservative, because what happens is, if we're in a down market or if we have a correction, people just went totally out of the market. And when I worked as a financial planner, I saw this firsthand, because I used to, this company that I worked for, this financial planning firm, I was in charge of the retirement plans. We had a lot of small businesses as clients, and they had these retirement plans, like doctors' offices, dentist offices, and small businesses. And my job was to manage these retirement plans, and I would give these people I would go out there once a year and give them their annual statements. So let me give you an interesting example of what happened when I worked at this financial planning firm. From 1997 to 2004, I worked for this firm. So during that time, in the late 90s, we had the whole dot-com bubble where the market was up 20% a year for 3, 4, 5 years. And then after 2000, the market became very volatile. And we had a couple of years where things were down to like 16, 20% down. So in the late 90s, when I'd go, people were happy. They were making 20% or more in their account every year. We had in most of these retirement accounts, the way they were done is the individual investors, the employees, they were not choosing their investments. There's sometimes, you're not going to probably have this because it's kind of rare, but if you some of these retirement accounts for small firms, the investment advisor, like our company, we were actually choosing the investments for all of the retirement accounts. In other words, it was pooled. They couldn't choose their individual investments. So anyway, long story short, late 90s, they're making money, they're happy. Then we have like 3 years of a downturn, of a down market. And so then when I would go out there and visit with these employees, they would complain and they would say, well, we want to be in cash. And I would explain to them, if we take the account to cash, you're not going to make any money. You'll maybe make 1% versus the average, which we were saying was about 8.5%. So, and this is what they would say in unison. I don't care if I'm only making 1%. I don't want to lose any money. So this is the disposition effect, where people, the pain of losing money is much greater than the elation of making money. And so people just, they have this bias where if the market's been in a correction, they've lost money, they just, they get too conservative and they don't want to be in anything that any stocks, to where they're going to have to take risk, which you shouldn't be, because in the long run, as you know, you have to be in the market to make money to even beat inflation. Okay, so that's the disposition effect. The ostrich effect, basically putting your head in the sand and just ignoring things, which I do. And a lot of us do this. If for example, I wouldn't do this in an investment account, but like in my retirement account, which I know is long term, if the market's in correction, I just don't even look at it. I just turn it off. I'll go maybe weeks or maybe even a month without even looking at it because it's so bad. But if market's up, I'll look at it every day. So that's the ostrich effect. So I guess you shouldn't do that. You should still look at things. Look at it if if you know it's gonna be negative. So anyway, now this isn't really this next thing I'm going to talk about isn't a behavioral, isn't something that they've coined, but I thought that this was a really good analogy. I heard this on CNBC. An investment advisor was talking about this, because people tend to trade too much. And a lot of times, if you just leave things alone, you're better off. And especially in this world that we live in with the technology that we have, where you can get into your account on your phone, it's so easy to trade. So this is what this investor said, this analyst. He said, your account is like a bar of soap. You take a shower or bath, every time you use that bar of soap, some of the soap is going to come off. It's going to get smaller. Well, every time you get into your account, you run the risk of making a mistake. And every time you trade, you run the risk of making a mistake, and you run the risk of losing money, is what they're saying. So, and studies have shown that the more people trade, they don't really make more money. The more people trade, they tend to lose money rather than make money. So be certain, in your account, that you are not trading too much. Just maybe leave things alone and be patient and see what happens. All right, so that's some of those. That's some of the behavioral financial theories. Here's some others. The house money I already talked about. You're gonna you're going to make riskier investments if you're playing with the house money. Okay, so that's those are the main ones I wanted to talk about. Um, Also, people have a selective memory. There's also something called the recency effect, where something that's happened more recently, you're going to give more weight to that. So, like recent news about a stock or a recent uptick or downtick, you're going to give more weight to that. So, these are the main ones that I wanted to talk about. Uh, so you can go in the book and kind of just have a general knowledge of these different behavioral finance issues that we're talking about. But those are the main ones that I wanted to focus on. All right. Oh, herding. Forgot about herding. Um, Herding is where you're just following the herd. Whatever the market is basically an auction. It's a bunch of buyers and sellers. If there's more buyers and sellers, market goes up. If there's more sellers than buyers, the market goes down. So herding is just following the trend. That's chasing. That can be dangerous because if you wait until things have turned, then you're chasing and things could go down. So I tend to, so that's a problem. I tend to agree with this, that herding is a bad deal. Now, another thing that people do is they tend to sell their winners too quickly. These are traders again. Sell their winners too quickly and hold on to their losers. Um, so what I mean by that is, let's say you're up in something, you sell out because you want to take the profits, but then something's gone down, and you hold on to that because it's gone down and you're waiting for it to go up. So if you do that consistently, sell your winners and hold your losers, what's going to happen? Well, you're going to end up with all losers in your account, and that can limit the profits that you're making. Another thing that I don't think is on the slides, another behavioral finance issue that I think is a very good one, is called anchoring. Anchoring is anchoring. So let's say that I bought, let me use Enphase. Enphase is a solar battery company. It was up around $220 or more earlier in 2021, and now it's down to about 170. So it's been as low as 140. So let's say that I bought it at 190. I thought I was getting a good buy, but it's had a correction, and so it's down to 190. I bought it at 190, and it's trading at about 170 right now. And I say to myself, well, I'm not going to sell it yet because I'm waiting for it to go back up to 190 because that's what I bought it for, and I don't want to take a loss. Well, that is called anchoring, and that's a flaw. The price that I bought it for is irrelevant. What matters is, where is it valued today? And so if I need to try to do some analysis and try to figure out, where is Enphase going? Well, if Enphase is never going back to 190. I mean, if it's fairly valued at, say, 180, I should wait till it gets to 180. If it's fairly valued at 170, I just need to cut my losses and get out of it. The point is, with anchoring, if you're trying to wait till something comes back up to a price where you bought it, that's wrong, because that's irrelevant. You need to, if you're thinking of selling a stock that you hold and it's been down, you need to figure out what the fair price is right now, and that's the only thing that matters. Okay, so those are the main behavioral finance issues that I wanted to discuss. Also, okay, next we're going to talk about technical analysis. Now, before we oh, wait a second. I didn't have one other thing I wanted to talk about. Let me go back to behavioral finance. In addition with this, with this anchoring, one thing that people will do to try to eliminate some of these behavioral finance issues, like anchoring and holding losers too long and selling the winners, is they will try to establish rules with themselves. Like, if a stock goes up by 10%, they'll sell 10% to take some profits. So they might sell into strength, in other words, to take some profits. And then they'll have another rule where they'll put a stop loss order in, where if a stock goes down by, say, 4 or 5%, they'll sell out of it. And so that's one way to limit the volatility in your market, in your account rather, in your account. But the problem with that is if you have a lot of volatility, you can have a stock that goes down 5% and then rebounds, and if you decide to sell it, you won't have it anymore. So, all this stuff is just some things to think about and ponder. Think about what's right for you. Okay, so let's look at technical analysis. So as I mentioned in that other video on with the your portfolio report, there's basically three areas that to focus on when you're trying to be in the stock market and make investments. The big picture, the most important thing, as I mentioned before, is really has nothing to do with math at all, nothing to do with all this technical stuff. It's just trying to identify trends before they happen. Try to identify, what are the macroeconomic trends? In other words, what does the future hold for a lot of these companies? Are people going to demand the product or service or not demand it? What do you think's gonna happen? And so if you can identify a trend, before everybody else does, you can make a lot of money in the market by buying those equities. So I think that and along those lines, I like to look at the big picture of the macroeconomic trends, geopolitical factors, and trying to pick stocks. Then I look at the fundamentals. I think that's the second most important, looking at the ratios and so forth. Then the last thing is technical analysis. That's looking at the charts. Where has the stock been? Where has it come from? So has it had a huge price run up, or is it down? Has it had a downturn in the price? That's the least. I think the technical analysis, in my opinion, is the least important of the three, but it's still a tool. And the fact of the matter is, if enough people believe in this technical analysis, believe in looking at the charts, then it does become a self-fulfilling prophecy. So I like to look at the charts too, just to see where a stock is. So if I've done all my other research, have a good feeling about a stock, and then I look at the technicals, and it's way up above all of its moving averages, and the RSI is at 80, then I have to think, well, maybe it's due for a downturn, even though it's a good company. Maybe I'll wait. Also, if I look at a stock and it's got a lot of bad news and it's undervalued, then I'll look at the technicals and see if it's really been beaten down. If it's way below its moving averages and the RSI is down to around 20, then all those things are aligning to tell me that it might be a good buy. One of a prior textbook that I had, that I used to use for this class, in the technical analysis chapter, I thought it was really interesting because they summed it all up by saying our brains are hardwired to look at patterns, graphs and patterns, and it's all historical information and is basically useless. So I thought that was kind of interesting. But as I mentioned, if enough people believe in it and act upon it, it does become a self-fulfilling prophecy. So refer back to the other video where I talk about the three main ones that I think you should know: the Bollinger Bands, the RSI, and the moving averages. So I'm not going to repeat all that, but let me show. This is kind of interesting. This Dow theory, this dogs of the Dow theory. You can skip the Barron's thing. You can skip this. I'll get back to the Dow theory, but let me talk about these charts right now. So this is just a chart where they're looking at if a stock, what a stock has done, and this is the highs and these are the lows. So this is the resistance line and this is the support line. This is kind of along the lines of the moving averages. So if a stock is expected, if you follow the technical analysis, it's expected to bounce off of this resistance line. If it breaks through, that's seen as a positive indicator and that you should buy it. Down here, if it breaks through a support line, that's a sell signal. And then typically it should bounce off of the support line. And if a stock goes way down here and turns, then this old support line becomes a resistance line, and vice versa. If a stock is way up and then turns down, this resistance line becomes a support line. So anyway, that's how they look at these charts. Now, this is kind of interesting. I haven't talked about this yet, This is called a candlestick pattern. So what these candlesticks are, this is the low of the day for this particular stock. This is the low of the day, this is the high of the day, and this is where it closed. So people will look at these candlesticks to try to figure out what a stock is going to do. So, if it's been closing like here, look, it closed at the low of the day for the past 4 days. So to me, that should tell me that I probably should buy this, because remember, a lot of this technical analysis, you take a contrarian view, you try to find extremes. So in this case, this might be a buy signal, and it does go up here. But anyway, here it's closed at its highs for the 3 days, so that might be a sell signal. Now, this whole thing here is called a head and shoulders. This is an interesting theory. What this tells us is that if a stock is forming a head and shoulders, I don't believe. Let me tell you from the beginning, I don't really believe in this, but this is what these analysts think. So, what could happen? So that you see, what the stock has gone up and reached a high and then come down. Then it's reached a newer high and come down. So this is the left shoulder, this is the head, and then if it reaches a lower high after the head, that's the right shoulder right here. So this classic head and shoulders pattern, typically what happens after this is that the stock will really go down. So if a stock is forming a classic head and shoulders pattern, a higher high, and then a lower high, it could be due for a downturn. And so this is a perfect example of what I'm saying. If enough people believe in this and they sell the stock, then of course it will go down. Okay, that's the head and shoulders. Now the moving averages I talked about already, and they refer to that other video for the moving averages. I don't want to repeat it all again. It's just sell signals and buy signals, whether you're at the resistance point or the support point. So you can just, again, refer to that video that I already made. Okay, this is kind of interesting. This has actually been proven to be untrue, but it is kind of interesting. Sometimes I do look at this just to see. So the dogs of the Dow theory is that it's looking at the dividend yield for stocks in the Dow Jones Industrial Average. So let me walk you through this. The Dow Jones Industrial Average is comprised of 30 stocks, as you know, 30 of the largest companies in the U.S. They're good companies. They have to pay dividends, and so to get in the Dow, you have to be a good company. Now, remember how to calculate the dividend yield. The annual dividend payment divided by the price. Okay, so if the price of a company, if their stock price goes down, the dividend yield is going to go up, right? So let's say that a company has a dividend that they pay $1 a year. Let's say they're paying let's say their dividend per year is $10, and the stock is selling for $100. Okay, theoretically. So 10 divided by 100 is 10, right? 10 times 10 is 100. So they would have a dividend yield of 10%. If you take $10 divided by $100, their dividend yield is 10%. What if the stock price drops to $50? Well, 10 divided by 50 is 20%. So the dividend yield just went from 10% to 20%. So you see, basically, what we're saying is that if a stock that has a really high dividend yield, the dividend yield has gone up because the price has gone down. So if you did a Google search in general and said you want to buy stocks, invest in stocks with high dividend yields, what you would need to do after that is look and see, why is the dividend yield high? Is the dividend yield high because the company is paying a really huge dividend, or is it because the stock price has gotten smized? So anyway, getting back to this dogs of the Dow theory, here's how the theory works. Find what they were doing with this one, the small dogs. they were, this is the Motley Fool, this company called the Motley Fool. They were doing this. They were finding the 5 stocks in the Dow Jones Industrial Average that had the highest dividend yield. And the idea was they've fallen on hard times for some reason, for one reason or another. They're good companies, but they're undervalued. And the signal of the reason we can see that they're undervalued is because their dividend yields are so high. So the idea is, if you buy these 5, the 5 highest dividend yield stocks in the Dow, you're going to make money because they're in the Dow, they're good companies, and they're going to rebound. So the Motley Fool people tried this for like 5-6 years, and it didn't pan out. They didn't make better returns at all. They actually didn't even beat the market. Why is this? Because not just because a company is in the Dow Jones Industrial Average, they can still be dogs. I mean, they can still be a bad company. It doesn't mean that they're, just because if they have a high dividend yield, the company's out of favor. It doesn't mean it's going to rebound just because it's in the Dow. They can be a crappy company that doesn't have a good business model, and they can actually end up being kicked out of the Dow. So, case in point, there's not one company left in the Dow that was in there from the beginning, from the late 1800s. The last one to be kicked out, because if a company's stock goes down like below $5 a share, if they stop paying a dividend, they'll get kicked out of the Dow. General Electric was the last one to be kicked out of the Dow. And so there's companies like Polaroid, Kodak. Kodak was kicked out of the Dow. Kodak is, basically a penny stock now. And so this theory doesn't really work because there are companies that can have business models that don't work anymore that can be in the Dow. However, I will look at high dividend yield stocks from time to time just to see, because that'll show me stocks that are undervalued. So you have to ferret out not just the ones in the Dow, but I'll just Google high dividend yield stocks and I'll look at these various companies, and you can find some companies that are truly undervalued. And then you have to ask yourself, is it, why is the price down, and are they going to rebound? And so that's an example of the dogs of the Dow. It doesn't work, but you can use that, a variation of that, to find high dividend yield stocks that are with good companies that are undervalued. It's a way to find undervalued stocks. Okay, so that's it for this chapter. So I hope that this chapter, more than any, I think is really interesting with the behavioral finance, and I hope that you will find some of this stuff useful. I always keep these behavioral biases in my head because I find myself succumbing to them, and it helps to keep the emotion out of making decisions, out of the moves that you might make in your investment account or in your retirement account. Okay, until next time, I will see you later.